Hello and welcome to our new Wilkins Southworth video. I'm Chris Wilkins. At Wilkins Southworth, we always explore the problem to ensure that you get the most proactive and best tax advice.
Making tax digital is already an international phenomenon. There's a general misconception that the UK government is somehow central to the development of making tax digital on the world stage. However, the reality is that similar schemes have been in operation for more than 10 years in some countries. Indeed, it would be fair to say that, in some ways, the UK authorities are behind the trend when it comes to tax and digital services. While results so far have been mixed, on the whole, it's safe to say there has been some substantial tax inflows due to the move to digital reporting. Countries such as Brazil are tackling the grey economy, having experienced corruption on an industrial scale for many years. Even though many worldwide online schemes also accommodate personal taxation, there is a heavy focus on VAT. Many governments see this as low-hanging fruit, ripe for the picking. Existing digital tax schemes. While many continue to fight the flight to online reporting, we have seen numerous governments worldwide moving to make this mandatory. While fraudsters tend to find a way around existing systems, the real-time reporting nature of some schemes is making it more and more difficult. Even though huge funds have been invested in digital projects, they have and continue to reap significant rewards. Some of the more prominent digital tax schemes around the world include Australia. Scheme name Digital by Default. The Australian government introduced the Digital by Default scheme back in 2013. To support the scheme going forward, the Australian government and regional authorities signed up for digital delivery of their services. This had a positive impact on the overall take-up of the scheme, with the majority of the pre-populated tax returns completed and filed online. Each year has also seen more elements of business reporting moved online, allowing the government to micromanage VAT returns. While there is still work to do, businesses are slowly but surely being converted to the scheme. It was also interesting to learn that the Australian authorities are using artificial intelligence, AI, and voice recognition software to support the Digital by Default scheme. Brazil. Scheme name Nota Fiscal Eletrônica, NFE. When putting together a case for making tax digital, many parties have used Brazil as an example of corruption on an industrial scale. This led to the introduction of the Nota Fiscal Eletrônica (NFE) scheme, which has been far-reaching and has had a considerable impact on businesses. The procedure involves the mandatory use of electronic invoicing when any taxable transaction occurs. All invoices must be submitted to the Brazilian tax authorities in real time. We can only imagine the millions of dollars the scheme has saved the Brazilian authorities, but there is still work to do. Even though the authorities are catching up on the criminals, there is still widespread corruption in many areas of the Brazilian economy. China. Scheme name FATR. China is often put forward as a country where individuals and businesses follow state guidance to the letter of the law. Unfortunately, this is not always the case, which has led to the digitization of the FATR system. This paper system has been in use since the 1980s and is now used as a basis for the Chinese government's digital revolution. Interestingly, while many countries have introduced digital services to recoup lost tax, digitization of the FATR system has helped many Chinese companies reduce their tax burden. You probably won't be surprised to learn that the Chinese government is currently looking to put together its own blockchain system. This would create an unbreakable chain which will track and validate business activities and tax obligations. Estonia. Scheme name X-Road. While often seen as a minnow, Estonia has been a leader in digitization. The original X-Road plan was developed and launched in 2001, although it has undergone massive changes. The tax system for individuals and companies has been revolutionized with a single shared digital platform, X-Road, central to the scheme. One single secure login based on an individual's digital identity has revolutionized the tax system. The ability to visualize your tax returns, make edits, and take online advice has led to a massive reduction in omissions and errors. The scheme has been so successful that the base technology is now used in Finland, the Faroe Islands, Iceland, Japan, and other countries. There are now more than 52,000 organisations using the system, with more than 1.5 billion transactions carried out each year and over 3,000 e-services available. It is believed that the system saves the Estonian people more than 1,340 years of work each year. To say that it has paid for itself is an understatement. Poland, scheme named Jednolitny Plik Kontrolny, JPK. On the 4th of July 2019, the Act on Tax on Goods and Services came into effect in Poland. This saw the introduction of electronic documentation covering VAT returns and the periodic reporting of transactional data. Known as JPK, the system uses the latest in cutting-edge technology. As a result, the Polish authorities can carry out in-depth compliance checks and take immediate action. This has placed the onus back on the individuals and companies to ensure that their tax returns are correct and they have fulfilled all their tax obligations. Mexico. Scheme name Comprobantes Fiscal Digital por Internet, CFDI. In a similar fashion to Brazil, Mexico has had its fair share of problems concerning fraud and non-payment of taxes. Therefore, it will come as no surprise to learn that the CFDI system was introduced back in 2010. Forcing all parties to complete e-documents, it allows the government to produce digital tax receipts. In 2017, the scheme was extended to include the tracking of payment receipts. While it is difficult to say with any great certainty how much money the scheme has saved, the Mexican government released some interesting statistics. Between 2010 and October 2016, they performed 11,000 electronic audits, with 5,358 fines handed out, raising more than 55 million Mexican pesos. We also know that 565 establishments were closed down for non-compliance with the scheme. Czech Republic. Scheme name Národní elektronický nástroj, NEN. Introduced in 2014, the Czech Republic's digital tax scheme, known as Národní elektronický nástroj, NEN. In reality, this change was forced on the Czech government after recognising a £2.2 billion annual VAT shortfall caused by fraud, error and omissions. In 2014, the authorities introduced digital tax reporting for VAT, followed by further business taxes in 2015. While optional for individuals, digital reporting is now mandatory for companies. Interestingly, the update in 2015 saw a controversial change to how cafes, hotels and restaurants are monitored. They are now legally obliged to upgrade their payment systems to interact with the NEN service. This will allow the government to track receipts in real time and compare and contrast them against VAT payments. There's no hiding. Spain. Scheme name Suministro Inmediato de Información, SII. The Spanish authorities introduced SII back in 2017 to combat a multi-billion euro VAT gap. In 2017, the gap was 5.8 billion euros, falling to 4.9 billion euros in 2018. The SII system saw companies with a minimum 6 million euro turnover forced to report their VAT digitally. There is an automatic penalty system, 0.5% of outstanding payments, with minimum fines of 300 euros and a maximum of 6,000 euros per quarter. Monitoring and reconciling VAT payments in digital format has been relatively successful. Consequently, in 2018, the scheme was rolled out in Basque Country and Navarra, parts of Spain independently administered. Italy. Scheme name Sistema di Interscambio. Italy is a country on the precipice of a public sector pension disaster, and it also has the largest VAT gap in Europe at 35.4 billion euros. While online pre-populated tax returns were introduced in 2015, the Italian tax filing system has been online for more than a decade. However, the change in January 2019 is seen by many as a game changer. On the 1st of January 2019, electronic invoicing was made mandatory for all private businesses and included all transactions. Each invoice must be delivered in electronic format with a digital signature to guarantee authenticity and reduce fraudulent activity. Individuals now having to put their names against e-documents has been a wake-up call. Those who fail to submit digital invoices can face penalties up to 180% of the VAT. VAT gap by EU member states. A report by the European Commission back in 2018 cast a very alarming light on the so-called VAT gap by member states. This difference between VAT receipts and expected receipts highlights some vast discrepancies. The top 10 worst offenders in the EU can be seen on this table. Considering these are just the top 10 worst offenders within the EU for 2018, we can only imagine the worldwide VAT shortfall. Consequently, while many countries have already introduced a variation of the Making Tax Digital scheme, others are very quickly following suit. EU VAT Report. The EU Commission publishes an annual report comparing and contrasting VAT total tax liability, VTTL, against VAT receipts. As you can see from this graph, there has been a fall of 16 billion euros in lost VAT between 2015 and 2019. As a percentage of VAT total tax liability, the gap has also fallen from 12.8% down to 10.3%. To put this into perspective, in 2019, EU VAT total tax liability 1,310 billion euros. EU VAT receipts 1,176 billion euros. EU VAT gap 134 billion euros. The EU budget for 2019 is broken down into two parts. Commitments 165.8 billion euros, payments 148.2 billion euros. Combined budget 314 billion euros. So even though the combined EU member state VAT income gap fell to just 135 billion euros in 2019, this is still 43% of the annual EU budget. This puts everything into perspective. Online returns and artificial intelligence, AI. The more information available in digital form, the easier it is to compare and contrast previous returns and flag any discrepancies. However, the use of AI will be groundbreaking for many countries. These systems can be programmed to accumulate information from various sources, compare and contrast and flag any discrepancies. They can also learn on the job due to an element of machine learning, ML, spotting and reacting to new trends. Over the last few years, we have seen massive investments into AI by governments and local authorities. In the right circumstances, this investment will be paid back multiple times. These digital workers are faster, more accurate and non-biased, helping to avoid any complications, although there will still be need for some human interaction regarding borderline issues. In theory and practice, AI systems will be able to spot problems, create reports and even issue correspondence and fines to the relevant parties. Summary. The taxation system as a whole has changed dramatically in recent years. While online personal tax returns have proved useful, the VAT digital returns will see government recoup vast amounts of lost income. For example, while the estimated level of lost VAT in Italy was more than 35 billion euros in 2018, the UK was losing an estimated 23.4 billion euros. These are vast amounts of money, and we can only estimate the lost revenue from years gone by. Gone forever. If you have any questions on Making Tax Digital, then please drop a comment below and we will get back to you as soon as possible. By the way, don't forget to subscribe to learn about other videos in this series.